Good morning. This is Jim Barlow with OakTree Strategic Leverage, and we're talking about family gifting today. Is there a better way? A, a transformative approach to family gifting using inversion wealth framework and Kaizen. Oh, I'm sorry. I wanted to tell you a little bit about me first before we go on. So here I am, a lifelong resident of Clearfield, Utah, married to Barbara, 7 children, 28 grandchildren. We have a great grandchild on the way. BYU graduate. We're devoted fans, investment advisor for 35 years. Our passions and values is our family, is everything. We love to travel, be together. We serve at the temple. And the reason for this business, I believe in doing good, helping others, using my expertise that I have to be of help to others as they join this world. Anyway, is there a better way? A transformative approach. Let's go. Most people ask, how do I win? What if that's the wrong question? Maybe a better question is, what would cause me to lose? What is inversion thinking? It's a way of solving problems backward. Instead of asking, how do I succeed? How do I win? You ask, what would cause this plan to fail? Then you eliminate those risks first. Why most wealth transfers fail? Most families don't lose wealth in markets. They lose it in the transfer. Poor timing, taxes, loss of control, decisions by the next generation. Maybe that's not what you really want. 2 ways wealth moves. The traditional way is you accumulate, you invest, you hope, you build it up, and you transfer it. Now, I'm going to call this the inversion way. Avoid ruin. Build a structure that helps you leverage, can be a benefit if you built the right structure, then transfer. Transfer is not the goal, it's the final test of the structure. How wealth actually moves. There's some automatic accounts, beneficiaries. If you're a beneficiary, if your wife is a beneficiary on your life insurance, it goes to her. If your ex-wife is your beneficiary of life insurance, it goes to her, automatic. Or there's legal, probate, wills, with a probate court. Or there's trust-based. You're starting to do a structure, controlled structure for your benefit. I'm a big fan of trust. Or some strategic system, insurance, business planning. Lifetime gifting, where decisions matter most. Let's look at things over. There's 3 kind of levels of gifting. There's simple, annual gifts. You can give it to almost anyone. I can give X amount to a child. My wife can give X amount. Simple. Or there's asset transfers where you transfer the stock to a son or something. There's some problems there. They take on the cost basis. Or there's structure transfers. What most gifting misses? The simple asset transfers. Control ends. Timing is uncertain, outcomes depend on others. Or there's a structured approach. Control is retained, timing is designed, outcomes are guided. The gift isn't the asset, It's the structure behind it. Most strategies focus on transferring assets. Sophisticated families focus on designing structure. When structure is wrong, taxes increase, control is lost, compounding stops. When structure is right, wealth lasts longer. Outcomes become predictable. Generations benefit. Two ways families give. The traditional way is parent to the child, control ends, or a structured, and we'll be talking about Kaizen, parent to the structure, to the family. Control, timing, and protection remains. The structure becomes the decision maker. So the question becomes, what would a gifting strategy look like if it were designed from the ground up, maintain control, reduce taxes, continue compounding, protect outcomes across generations? That's what led me to a new framework. I designed, put together what I call the inversion wealth framework. So first, we avoid ruin. We put some rules. We do an inversion strategy that we've been talking about. We'll give a little more. Then we build the structure. Then if we've done that properly, inversion and structure, we can do some leverage, multiplication to get better returns. And then we sit down and let patience help us compound. Let me talk over these four layers. Avoid ruin first. Identify what destroys wealth. Eliminate irreversible risk. Focus on survival before growth. That's the inversion. Win by not losing. The next layer is structure. Build what cannot break. Eliminate what causes failure. Ensure decisions are never forced. Design for pressure, not perfection. If it can break you, it doesn't belong. Layer 3, leverage. Use capital more efficiently. Not reckless leverage, not great amount, structured leverage. Define entry, controlled exposure, planned exit. More capital working without more risk. Making money on other people's money. Layer 4 is patience. Let time do the heavy lifting. Compounding requires stability. Stability requires structure. Time rewards what survives. Everyone pretty understands these three levels: inversion, see the risk, leverage, increase potential, patience, let it compound. But they fail at one place. Structure is the bottleneck, where execution breaks, where risk is left exposed, where plans rely on behavior instead of design. This is where most people get stuck, not because they don't understand, but because they never built what makes it work. Structure is the hinge point, where thinking becomes real, where risk is removed, not managed, where outcomes begin to shift. Inversion, we see the risk. Structure, we solve the risk. Then do the leverage, then do the patience. This is the moment everything changes, when structure doesn't just describe the plan, it defines the outcome. The right structure becomes the fulcrum. Small inputs create large outcomes. Leverage becomes safe and predictable. Time begins working for you. Structure's the edge, not just where things change, it's where power is created. Most people try to win with better returns. few who win consistently build a structure that can't break and then let leverage and time do the work. So let's go into Kaizen. This is a transformative structure built on cash value life insurance and index universal life that eliminates downside risk, uses institutional leverage, creates tax-efficient income, defines a clear exit strategy. How it works. You contribute for 5 years. The bank contributes alongside of you for 5 years. Then they continue paying, funding the policy for the next 5 years. Policy grows, build-in protection, and then the loan is repaid in 15th year. From that point on, the structure is fully yours, unencumbered, income ready, major flexibility. Then, why it fits this framework? Why does Kaizen fit this framework? Well, downside protection, zero floor, defined system, not market guessing. The structure, about 3-to-1 institutional leverage, and long-term compounding. Kaizen, we talked about and gave you some information about family gifting, but it really can be used for a lot of areas: retirement income, family protection, just regular buying the insurance part, creditor protection, doctors especially like it, tax efficient income, it becomes tax free, charitable gifting, key man, business succession, employee retention. These are the multiple uses of Kaizen. Who is it for? Best fit, I guess I should say it's not for everyone. For high income earners, business owners, professional, family thinking generationally. Qualifications. There is some qualifications. The age is 18 to 65. Your health needs to be standard or better. Income, 100,000 or more. Capacity, you need to be able to be 20 to 40,000 per year for 5 years. And during the growth time and the leverage time, you need to give it some time, a commitment of 15 years. If you're not really in that 15-year range, it's not the right product. Okay, we're going to now go over kind of all the details, not in major detail, but we're going to try to give you everything involved with Kaizen. I've got 4 different categories of slides, and we're going to talk about the foundation, the growth part, the control part, and then the leverage part. The foundation. There's a death benefit. It's life insurance. That's the chassis we're building this on. Then there's living benefits. Protection when life doesn't go as planned. And I think I got a slide on that. Yeah, I added this week. These living benefits, chronic illness, access for long-term care, terminal illness, critical illness, lump sum for major health events, critical injury, support severe injuries, cognitive impairment, Alzheimer's. I think this is one of the beauties of life insurance today, these living benefits. So death benefit, living benefit, grows tax deferred, and we can access it for your retirement or whatever, tax free. And there's efficiencies. Yes, there are insurance costs, but there's no advisory fee or management fee. A lot of fees are lower. That's the foundation. Death benefit, living benefit, tax-free, efficiencies. The growth. You get market-linked growth, participation in market gains, with zero downside floor. Big deal. And continuous compounding. After a major down year, and you're down where other people are down 30 or something or percent, you didn't go down, so your continuous compounding, your recovery is quicker and better. I'd like to show you how that no downside works. Most of the premium is allocated to high-grade bonds. That's with a small portion used for index options. Example, $1,000 premium, $950 would go to the safety of bonds, grows back to $1,000 in a year. That's how they can guarantee it. The majority is in bonds that grows back to the principal. Then they take $50 and put it into options linked to an index of your choosing. Protection first, growth second. The sequencing is what makes the structure transformative here. Hope that helps. Here's a little bit of a quick view of a little bit of these indexes. There's indexes like the Standard & Poor's 500 that has a cap. And this is the current 5 and 10 and 15-year returns for this index that if you choose to go with the 500. Then there's other indexes that have a participation rate more than 100. In the U.S. Pacesetter Index, the current participation is 260% because we're buying options, and that's how much options we can buy right now. So the 5-year average is 9.56, 11.83 for 10, 14.82. That's the two major kind of indexes you have available, both with zero floor. Now the control. Protected ownership. We set this up in a trust in your name, and we set up a master trust that does all the management and do the borrowing and the leverage and the bank associations. That's the first thing of control. Then we only have this 5 years of funding. We didn't want this to last forever. We want it simple for you to visualize. Turnkey design. Minimum management is this will be as cake as you will ever have. Flexible liquidity after the 15 years. Before the 15 years, less access, but after 15 years, there's no requirement of distribution. We're going to have no taxes. And we add on, to make all these things work, we add a bunch of key riders, about 24, 25 of them, designed to reinforce control and protect the structure. This is kind of the building area of Kaizen. Here's a little visualization of this 3-to-1 leverage. The silver pegs represent you, the investors' yearly payments. Then the bank, the gold pegs, is approximately paying the same amount for the first 5 years. Then you are done at 5 years. The bank continues to make their payments they were making, and then they start making the payments you are making. And so money goes into this account for 10 years. Got to see why you got to go beyond 10 years, get all the borrowed money you can. That's a simple visualization. And this is without any credit checks, loan document, no personal guarantee, no signature. There's no collateral. We have built this so it's as safe as you can get. Then the leverage. We use institutional capital. We're borrowing in a tranche many policies, approximately 3-to-1, the lowest rates possible. Non-recourse structure, just mentioned that, no collateral. Efficient capital use. You can invest your assets in other places because you've you're doing borrowed money to get more efficiency, which also gives you accelerated outcomes, reach objectives sooner. Leverage is a cool blessing. And I've kind of hinted towards it, but there is life insurance costs, but the structure creates benefits. The insurance cost is based on death benefit, age of the insured, the health of the insured. These factors determine the underlying insurance charges. As a 35-year investment advisor, I wanted to know a percent, but you can't put a percent because it's all variable on death, the amount you want, the age, and your health. So the real question in my mind is not, is there a cost? The real question is, do the benefits of this structure exceed those costs? The insurance chassis allows Kaiser to provide downside protection, tax advantage income, death benefit protections, safe leverage, liquidity. Ultimately, this isn't about minimizing costs, although we do that. It's about whether the structure creates a transformative net income. I'm going to give you a hypothetical here, and this is going to show you that even though there's costs, the structure virtually gives you free insurance, and because it's going to be competitive in the investment world. This is our primary software. We call it Interactive Learning Information Assistant. You have to have a login for this, but I can send you an invitation, whoever would like to have access to this. I'll show you some other access that you don't need that. But this software is what I'm going to crunch numbers with. I'm going to use this hypothetical. A 46-year-old male, I should probably put that down, excellent health. He wants to put in $70,000 a year for 5 years. We start receiving distribution at 65. He wants to make sure it lasts till 70. And we had to do some assumptions. The 6.81 is the regulated return and associated with the National Association of Insurance Commissioners. I chose 46 and 70,000 because that's the average age of Kaizen investors in our country. And the 70,000 is the average payment they're putting into it. So you're seeing the average guy, what it looks like. I'm going to show you some numbers. We're going to show you the Kaizen number, the beginning distribution we can get from the 70,000 a year at 6.81. We'll give you the beginning distribution, 65. We'll show you the total distribution through age 90. We'll show you the death benefit. We're going to show you the remaining death benefit age 90. And I'm going to compare this with an after-tax investment and a tax-deferred investment to show you some comparison. So first, the after-tax. If we invest $70,000 a year for 5 years at 6.81, pay taxes as we go, we can pull out $58,642 starting at 65, and that will last for sure. Well, I guess I can't say for sure, at 6.81 through age 90. I've used every penny to give that highest income for those years. Now, in this quirky scenario, that means at 91, there's no income. If you're using this illustration system, we can put the beginning age and the ending age, 100 or whatever you want, but I went with 90. 58,000. If we do it in a IRA or 401k, it's more money. Because of the tax deferral, you got more money per year, and what about 400,000 more through age 90? Now, Kaizen, what do you think? Do you think Kaizen, if we do a drum roll, please, do you think Kaizen will be higher than 74? How much higher? 84, 94? Well, 130. Wow. No downside. Market participation, tax-free, borrowed money, the leverage. This gives you more income. You'll be able to pull out 3,380,000 through 90, and you have the death benefit when you began at 46, and you still have a death benefit or money you can pull out for additional income. So, in a sense, the insurance became free, competitive against after-tax and tax-deferred investment. Now, the two worst case scenarios we stress tested Kaizen against was the 1980s, the high interest rate environment. I was married in 73. I know in the 80s, we were having our children, we were teenagers. Anyway, the loan rates got up to 16.88. Does Kaizen withstand this kind of a scenario? Or can Kaizen withstand the Great Depression, the worst sequence of investment returns in U.S. history? We're going to plan on 9 years of zero return over 12 years. Notice no negatives. Does it weather the storm? Well, here we go. The 1980s, it had been 97,500 instead of 130. Well, it's lower, but it's higher than 58 and 74. Oh, and would those go down too in the 1980s? Yeah. If I go down the same percent, the one would be 43, the other would be 55. So you're doing well all the way around. So what if we go to the Great Depression? Oh, it's lower than 97. It's 84,500. And the stress testing, oh, there we go. The stress testing, the others are in 38 and 48. You'd be pretty happy with the 84. Still higher than 74 and 58. Looks nice. Looks nice. Kaizen is inversion oriented, protecting the downside. Got another drum roll. Allianz, one of our insurance companies we use, did a study on our ILIA illustration system. They wanted to make sure these numbers were accurate. They want to analyze this. We gave them full rein, and they studied it and looked it over, and they think there's a 80% chance that the 130,000 of Kaizen, 80% chance is double. 80% chance, and it's not 130%, 30,000 is 260,000. So by this inversion strategy of eliminating risk, no downside, tax-free, borrowed money, we've gone from 58,000 for after-tax investment, 130 to 260. What I did here, this was an excellent health. Well, what if I had this pillow was just average health? Well, it went down from 130 to 120. Not bad. And so the double would have been 240. Average health is still okay. You're going to beat these entities. I also did another study. I did, what if it's a female? 133,000 instead of 130. Better life expectancy for females. So there we go. There's my illustration. Kaizen works. Here is the very first policy. The numbers on the very first policy issued in 2012, June 27th, 2025 was the last anniversary coming up. This first policy has averaged 7.85% return. The average interest paid has been 3.95. So that means on their money, they made 7.85, but on the borrowed money, 7.85 subtract 3.95, they made 3.9 on all the borrowed money. That was what we wanted. Now, long-term historical SP 500, around 10%. Well, that 7.85 isn't 10%, Jim. Remember, 7.85 is tax advantage. It can become tax-free. So if we take the taxes off of that 10%, I'm using just 25%. It'd be 7.5. We're in the market. We're probably maybe even a lot higher than the average investor. So the Kaizen principle. Most people focus on outcomes. Wise people focus on how the system is structured because results rarely fail from lack of effort. They fail from poor design. Inversion teaches us to ask this better question: what results do I want? Not what result do I want, but what structure produces the results consistently. Because success is not an event, it is a system. Structure first, results second. Transformation follows structure. I'd like to show you the ways you can learn more about Kaizen. I got 4 ways. This is a landing page. You don't have to have a login for this one. You can just go to it. There's videos. There's actually 10 chapters of the whole book on Kaizen here to answer all your questions. Good site, nicely put together. And this one is kind of the same, but it's on this gifting strategy we've been talking about today. This is a lot of the same videos, but additional videos and chapters about how to do this gifting. These 2 you can just use and study on your own. Call me for questions. Then we have the ILIA. If you graduate from those first 2, you'll want to go here because you can do a great, not only an estimate by benefit, you can actually get the exact quote from the insurance companies and a lot of detail. So that'd be the next step. Other is just my website. I've got a lot of links on my website. You can go to learn a lot of different things. I like to think I'm improving it all the time. I built a retirement income gap calculator, a basic and a tougher one. I forgot the word I used, advanced. Anyway, this will show you, put in the numbers, easy to do. It'll tell you if you're on track. You're going to find out if there's an income gap right now in your life, if you're ready for retirement. I think I love it. It's on my website, free to use, no charge for sure. There's a couple of ways to engage with me, engage with Kaizen. One is online with those 2 landing pages. I'm there to advisor back, but learn at your own pace, digital engagement, OakTree guidance available as you need me. Or if you're more traditional, I can be a one-on-one guy. I can take it at dinner or lunch or whatever. I can go over it in detail. I know it backwards and forward. Whatever way you want to do it. It's the same strategy, just 2 different engagement styles. Maybe the one is the new Amazon approach. The right path fits how you think and decide. Service, after you buy it, there's all kinds of parties. There's me involved. There's NIW. They're the founders, the designers of Kaizen. they're involved for sure for 15 years because they're involved in the leverage and everything. There's the insurance companies, the insurance carriers, they're involved. Um, I should put, well, I guess I should probably put it as a separate, the trust company who's involved there. That gives you another one. So even if I'm no longer involved, you hear what I'm saying there, right? I don't know when, but you don't need to worry about it. It's already built together, very low key. It's done. So here's the list of my webinars. I cut the names a little bit short. So first, I have an investment using inversion wealth framework. There's retirement. There's family gifting. That's today. Those are the monthly ones. Then every other month, I do the executive, employee benefit, and succession. And next week is the executive. And the last three, I haven't built them yet. I've got the basic concepts together, but I haven't done the work. I'll get to those. Here's our webinars coming up. Next week is executive employee benefits. Then April 30th, we've got go back to the flagship, the basic one. On the 5th of May, we've got retirement and full circle. I've got on May 12th, I've got the retirement. The family gifting. So there's the next four. I didn't put the link on the bottom one. So what clients tell me matter most of I've been asking. These are the benefits client consistently value the most. Zero downside floor. No negative years. Tax-free growth and access. Wow. Flexible liquidity after the 15 years. A lot of flexibility. Finite funding, only 5 years. And the death benefit and the living benefit. These are not about chasing high returns. They're about removing risk, increasing control, creating certainty. So after 35 years in the investment business, I've learned to separate products from structures. Most financial tools are products, a stock or a bond. Few are structural. When someone has the runway, the time, and the health to qualify, I've yet to see a more efficient long-term structure than Kaizen. Because when properly designed, it becomes transformative by nature. So let's see, 11:38. I want to keep this under 45 minutes. I'm doing okay. That's the flagship one. All my webinars I post within a day or two on my website. So this very webinar you're watching today, it'll be there for sure by the weekend, but the next few days. The basic one, the flagship, is there already, and others that I've done in the past. And there's my phone number, my email address, my website. There's the 2 QR codes for those 2 landing pages. I hope you've had a great time. If you have questions, write them down. I'll be happy to help. And with that, let's say, have a great afternoon. It's almost noon. Have a great day. Bye.